Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little money. My job is not just to entertain, but explain crazy days like today. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. All right, the market has officially lost its mojo. So we're back to loving tech and just tech and not much else. That's how I feel after the Fed meeting today, after it broke up with Fed Chief Jay Powell explaining why policy is staying the same. There won't necessarily be a rate cut on the horizon. Not happening. Most of the market could benefit from a rate cut, but it would mean very little to companies like Microsoft or Meta, two hyperscaling members of the Magnificent Seven, veritable nation states that shot the lights out when they reported after the close tonight. I always find days like today mystifying. See, there's this camp. I'm going to call them an ill-informed segment because I used the word stupid too many times this morning, that somehow expects a surprise from the Fed, like a rate cut when it's least expected.
They know nothing!
Then when they don't get the surprise, what do?
Sell.
Which is why the Dow only lost 172 points today. S&P shed 0.12%. NASDAQ actually gained 0.15%, though. I always say to myself, what are these numbskulls thinking? How can they be disappointed about something we all saw coming? The ironic part is that in the wake of their selling, we have a market that doesn't seem to have any oomph to it, aside from a handful of tech giants and their fellow travelers, like it's been for so long. We just say, you know what? All we're going to get is a boatload of attacks from the president against Chairman Powell, especially because there's no Fed meeting until September, for heaven's sake. So there's nothing that can be rectified. In the interim, it's just one more reason for Wall Street to freak out about the Fed losing its independence. But with the Fed meeting out of the way, we're back to worrying about earnings. And today we had a new wrinkle that rankled. See, the Fed chief, so worried about cutting rates too soon, did tell us the consumer ain't as strong as she used to be, and housing's weaker than it should be, and then he does nothing. Look, I totally understand why Powell wants to wait. By historical standards, it would be kind of crazy for the Fed to cut rates here. We got a healthy GDP growth found out just today, much better than expected, and maybe even accelerating when it comes to tech spend. We have a strong labor market. We have very little indication of prices coming down, even if they're not going up as fast as they used to be. We've got new tariffs that, for the moment, are mostly being eaten by the companies that ship things to America. But what happens when they start passing their higher costs along to you, as they almost always do in the end? No Fed chief wants to be the guy who cuts too early and lets inflation make a comeback. But the president's demanding rate cuts yesterday. I get that, too. We have the intractable price of housing. It refuses to come down. And the possibility, just the possibility, that the consumer's truly slowing. We got weak numbers yesterday from Stanley Black & Decker, United Parcel, PayPal, and Whirlpool, which makes us wonder if we might be at the beginning of a slowdown. Today, though, no real follow-up. For instance, credit card giant Visa said business is quite strong. It's hard to say if business is slowing when a $700 billion market cap Visa is crowing about how things are looking good. Starbucks, which makes a pricey cup of coffee, if you ask me, told us this morning that business is coming back after a prolonged downturn. More on that one later. Again, it's hard to imagine that the economy is really getting worse if that's the case. In short, the backdrop's just too darn mixed for the Fed to take action. That's also why Powell pretty much punted on that forecast, because who knows what the heck the future's going to look like. Certainly not the Federal Reserve, which is why they're so reluctant to make a move until they know more. Yet we know the president won't let up no matter what, even if Powell's right. What does the president care? It won't be Trump's reputation that's tarnished if we get more inflation. It'll be Powell's. The president's got a free hand to say whatever he wants. Powell just has a number, a quarter point, a half point, or whatever, and he'll be hanged on that number if he cuts and inflation comes back. What does all of this have to do with your portfolio? I got to tell you, I think it's a buzzkill for about 75% of the stocks in the S&P 500. If the broader market's going to keep climbing, and we want it to so badly, I think we do need lower rates. There are whole swaths of the economy that aren't doing all that well, mostly connected to housing, but housing punches above its weight. But that is the real battleground. If you cut short-term interest rates, the rates that the Fed controls, and there's this much strength in the economy, what would happen to the long rates that mortgages are priced off of? Would mortgage interest rates go higher? I mean, will they go up or they go down? We don't really know. Do you know that rates went up on the long end when the Fed cut rates last time on the short end? Maybe we'll know more on Friday when we get the employment number. If it's weak, then the president's endless hectoring of Jay Powell might be a little more justified. But if it's strong, then we know there won't be any rate cuts from the Fed to help the stock market go higher. But remember, we're talking about the broader stock market. Let's talk about the stock market that continues to just climb like mad. See, we have to revert to individual tech stocks. And if you aren't, look, if you're just in an index fund, you can pivot right now to buy what's really smoking. And tonight we found out that the smoke's coming from Meta and Microsoft. Coming in earnings, the street was worried that Mark Zuckerberg might be paying too much for talent. But when we looked at the numbers, we had to laugh. Like a great baseball team owner, Zuckerberg can overpay all he wants. Meta's winning the championships with these numbers, which were sharply better than even the most bullish of Meta's Amen chorus. Plus, they gave us an amazingly strong forecast, much higher than expected revenue, with their capital expenditure budget coming in at the low end. Of course, what does that have to do with the Fed, right? Meanwhile, Microsoft also reported a monster top and bottom line beat with tremendous strength in their Azure cloud infrastructure business. Many people think that's the most important division, where growth accelerated from 35% to 39% in just 3 months. This is a huge business. That's incredible. Their AI business is on fire, too. The scale of the sales and earnings beat here were pretty staggering. I am shocked at the strength we're seeing here. Microsoft, like Meta, is spending fortunes on hardware and software, and it just keeps paying off. As always, we have to wait until the Microsoft earnings call, which is ongoing, to get the company's forecast and thus the full story. But the numbers that are reported for this quarter, they are incredible. But these two core Magnificent Seven companies do not relate much to anything that Jay Powell's talking about. As I call them, they are nation states of their own. Aside from these heavy hitters and companies like NVIDIA that help them accomplish these astonishing results, you can't get the rest of the market moving up without some sign that the Fed will backstop us. Maybe we shouldn't even care. The bottom line, I think this market fell apart today because the Fed seems reluctant to give us that rate cut backstop. I didn't get the sense of the so-called inevitability of rate cuts that I felt from the last two Fed meetings. Judging by the action, not many others did either. But you know what? After the close, maybe Microsoft and Meta set us all right. Let's go to Sam in Massachusetts. Sam.
Jim, how are you?
I am good, Sam. How about you?
Good. You know, Jim, I'm calling you tonight not just as an investor, but as an avid distance runner who put over 1,000 miles in the on-cloud monster. See, after running in the shoe the first time, I was a real evangelist for the company. I even bought the stock, bought a huge position in On Holdings. But after running over 1,000 miles in their shoe, I noticed a design flaw that not just myself, but my friends have reported. The back of the shoe digs into the Achilles. Now, if they would fix this issue, this company has the best shoe in the world. But with this issue, I got issues with the repeat purchases.
Okay.
I'm worried. I'm worried about the.
Well, let me tell you something. The reason why I like the stock is that they have adjusted every time that there's been a problem. Roger Federer and his team have adjusted. And I think that if there's really something that's lasting and negative, they will fix it, which is one of the reasons why I do like On. I am concerned that Nike may be making a comeback and take business from On, but I think On is a decent buy here. Let's go to Aaron in Illinois. Aaron.
Hey, Jim. Happy to be talking to you. I started investing 10 years ago, and since then I've learned so much from you and some of your colleagues at CNBC. I just wanted to say thank you for what you do.
Oh, and we thank you right back. That's a terrific comment. Thank you so much.
I appreciate what you've been saying about it being an ideas economy, because I think there are so many exciting things happening. The company I want to ask you about is Intel, INTC. I got excited about this company a few years ago when they said they were going to go into the foundry, which I think is a critical need in this country to make these chips. And, you know, based on their last earnings report, it seems like they're flubbing it. So what's your take on the foundry, and what should I do about Intel?
Okay, the foundry was ill-advised. You're right, we need them in the country, but they are not necessarily profitable. And Intel, the previous CEO, was spending far too much on them. We have a new CEO at Intel. The CEO's name is Lip-Bu Tan, and he totally understands everything I just mentioned about foundries. He did make me feel that a turn is not yet at hand. It's still a little too early. If you started buying here, I think you're going to be able to just kind of break even versus so many others, including my favorite, NVIDIA. All right, listen, I didn't get a sense of any inevitability of rate cuts today like I have in past meetings. But you know what? The market didn't either. However, Microsoft and Meta kind of overwhelmed all the negativity at the end of the night. On Mad Money tonight, VF Corp, the parent of Vans and North Face, is up majorly after its better than expected quarter. I'm digging into the impressive report with the company's top brass. Then Wall Street is starting to see the vision that Starbucks CEO Brian Niccol planned for the coffee giant. I'm sharing why I also feel confident after last night's report. And Vertiv's quarter gave us a real look at the strength in the data center that I just referred to with Microsoft and with Meta. I'm getting a sense of the demand for AI-driven infrastructure with the CEO. And let me tell you something, it's pretty darn strong. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Has VF Corp finally gotten its groove back? This footwear and apparel company you know as maybe Vans or the North Face Timberland reported a magnificent quarter this morning. The stock actually shot up 3% today, though it was up much more than earlier. You know what the Fed did. Here's a stock that's been a real dog for a long time, frankly. But 2 years ago, the board brought in Bracken Darrell, formerly the CEO of Logitech, to turn things around, and now it looks like he's starting to pull it off. But don't take it from me. Earlier today, we spoke with Bracken Darrell, the president and CEO of VF Corp. Take a look. We are going to go over what I think is one of the most controversial stories that shouldn't be. It shouldn't be because we have Bracken Darrell who's in charge of it, so it was only just a matter of time. Bracken, welcome back to the show.
Thank you so much for having us.
Okay, so the big sticking point here has not been North Face. Has been really good. It's not been Timberland. Wow, I really like it. It's been Vans. And this is the first time since you've gotten there that I detect genuine green shoots in many different ways. So I am going to ask you, can Vans be turned around in the next year?
You know, Vans is going to be turned around, and I'm not giving an exact time frame, but Vans is absolutely going to be turned around. We've got, as you said, we've got green shoots at the very top. You know, we've got at this year's Paris Fashion Week was just last month. There were probably more skate-like shoes there than have been in a decade. And you know, these trends start at the top. So there's really good luxury trends. In our stores, we're overpopulating with premium product. We're doing super well. The Oxford Street store in London, the Fifth Avenue Street store in New York. So I see the green shoots too, and it feels good. And I just, you know, maybe we'll talk about the Warped Tour, but you can feel it there too.
Well, let me just ask you, why has it been so hard? What happened to make what I regard as being a premium, exciting brand into a brand that's really seemed to be, even for you, a not easy turn?
You know, there are three things that really happened there. First, the innovation pipeline got very stale. We just didn't launch new products. And then the second thing was they really overextended into value doors with those same shoes that were going very, very broad. They look the same, we're the same. So we just overdid it with a couple of styles. And then the marketing got stale. So those three things, though, were really reversing engines. So it's taken longer because we've had to really reset the distribution. So we've pulled back on value doors. We've reduced the scope of what we're selling in there. We've reduced our own number of doors by about almost 20%. And you know, the net effect of all that is it's a slower turn. In this industry, it takes time to get new products out. So we've got a great team, though, a super leader, and we're going to be a machine rolling out new products over the next year and a half.
Okay, in the interim, it is very telling that North Face remains not only a premium brand, but one that has gotten very exciting again. It never lost it in Europe. I think that people in Europe are just always very exciting about it. But the United States, which has been, of course, an obviously important market, seems to have caught fire. So give us a sense of where North Face is now.
You know, North Face is, as you said, it's always been a terrific brand. It really stands for exploration. And, you know, that's appealing to everybody. What we're doing now is we're continuing to innovate in the core business, but we're also bringing out more and more footwear. Our bags and packs business, which is one of the oldest part, both those segments of the business grew over 20% globally. And we're just going to keep pouring it on. And we've got so many opportunities in just bringing out more product for the spring and summer as we go into next spring and summer. So there's a lot of opportunity on North Face globally.
All right, now, Timberland, it seems very exciting at 9% growth. This is a brand that we remember as being fantastic. Then it got small. Can it get big again?
I think so. I mean, I think really Timberland is one of those brands for us that is the brand itself is so much bigger than the business. And the potential, we've really caught fire on the yellow boot, as you said, but we've also got really clear signs that the boat shoe, remember those boat shoes that we used to wear when we were kids? Those are starting to pick up steam again, especially in Europe, but even here in the U.S. And we're really working hard to fuel both those engines and then bring on more and more new products and more apparel. So we've got a lot of opportunities in Timberland too.
Right now, I had to ask around the office. I always feel old when I do that. But Altra, people are. I thought it was like a cigarette. Altra is a hot shoe.
It's about as far from a cigarette as you can get. It's the best trail running shoe you can buy. It's the biggest actually in trail running. We're tied for number one in trail running. We're also moving up fast, the fastest growing of the top 8 shoes or eight brands in road running, believe it or not. And it's gone from about $60 million when we bought it to about 250 this year. It should be 250 or 250 plus this year. So it's really on fire. It's a great shoe, has a unique point of difference, this wide toe box that's really healthier for your foot. So the people who get in it are hooked. And here's the really unbelievable thing. It's a $250 million business at run rate with less than 10% awareness in the U.S. And probably that's aided awareness, meaning, have you ever heard of Ultra? And so people like you, like 90% of people like you, and outside the U.S. it's even smaller. So we can scale this business.
All right, that's important because I'd love to see, without having to spend more money, I don't want you to buy anything till you get your balance sheet where you want it, but that's very exciting. Now there is there's a brand called Carhartt, and we all know it's fantastic. And then you have a brand called Dickies. Now, I told you I bought that jacket at Walmart for $25. It was a Dickies jacket. I would have paid $50. I don't know why Doug McMillon is giving it away at $25, but could Dickies ever be Carhartt?
First, I love Doug, the CEO of Walmart, and you do too. So whatever he's pricing at, I'm okay with it. Look, I think we don't have to beat Carhartt. We have to be the best Dickies we could possibly be. We haven't in the last few years. Now the trends on there are improving too. So there was a turnaround to do there, and it really dampened this quarter, got into single digits. And I'm really optimistic about that business too. I've got a fantastic team there led by a super guy, Chris Goebel out of Gap, and he's brought in just a superstar team there. So just like Sunshea at Vans and Caroline Brown and Nina Flood, I've got 4 really great big brand leaders now.
All right, and then last thing, Bracken, I know that you're dealing with the tariffs. You've been able to mitigate some, not all. How life-threatening is a tariff to VF Corp?
Look, the tariffs are the great thing about the tariffs is that they treat everybody equally in our industry. Just everybody's kind of in the same boat. So in an environment like that, we can deal with it. So we're taking cost out, we're relocating factories, and we're raising prices. And we will manage it all. As we go into 27, we'll manage it all so that during 27, we'll offset all the tariffs between those 3 mechanisms. So it's not life-threatening. We will manage it.
Well, if you had to raise price, is the consumer strong enough to be able to take price?
I think so. We're going to do it very strategically. And as I said, the good thing is when you're looking at alternatives, if everybody's raising price, and I suspect they will be in our industry because everybody's going to have the same cost increase, then prices will go up. And then it comes back to let the best brands win. And we believe we have great brands.
Well, I think your situation is, oh, God, I want to own the stock myself, not allowed to, but I think it's really time for Bracken Darrell, President and CEO of VF Corp. Brack, I love when you're on the show. Thanks so much. Thank you so much.
Hey, Jim, I just have to say, I now bought on my own. I've taken $3 million of my own money, one by one, and bought stock myself. So I'm obviously more than just a believer. I'm personally invested beyond what you normally get as a CEO.
I like a CEO who's all in with his own money rather than just having the shareholders give it to him. It's because it's much more real that way. Thank you, Bracken. Great to see you again.
Thank you.
That's Bracken Darrell, President and CEO of VF Corp. Thank you.
Coming up, investors had a tall order for Starbucks' latest quarter. Cramer's checking in on the coffee chain and its turnaround efforts. Next.
What do we make of these numbers that Starbucks reported last night? Initially, the stock tumbled in after hours trading. Then it shot up to $97 at the open, then plunged again to $90 less than an hour later, before rebounding to finish the day effectively flat. They've given you the full roller coaster experience over the past 24 hours. Even though the headline numbers were weaker than expected, I found the overall results to be pretty encouraging. Keep in mind, Starbucks has been a long-term holding for my charitable trust. Not always a good holding, but for the past year, ever since they poached Brian Niccol from Chipotle to take over as CEO, stock's been doing much better. Brian orchestrated an incredible turnaround at Chipotle, and I think he can do the same at Starbucks. That's why the stock jumped almost 25% on the day he was hired. The stock kept climbing until this March, when everybody started worrying about tariffs and the fact that the turn might be more difficult than first thought, which is why the stock plunged to the high 70s in April, before ultimately rebounding to the low 90s as of today. Throughout this period, we've stuck with Starbucks because I believe Brian can deliver another turnaround here. He's got a plan to solve the throughput problem. This is a chain with too many customers, so they need to be able to process your orders more quickly with a goal of less than 4 minutes. He's also trying to improve the in-store experience, getting back to the Starbucks of old, the old third place between home and office. Along the way, though, the numbers, let's say they've been pretty choppy. When the company reported in late April, they posted a top and bottom line miss, with some of their worst numbers coming from the United States business, sparking fears that the turnaround could be further out than we thought. Now, look, I remain a believer. I told Investing Club members to be a big buyer, but things did feel pretty grim. Fast forward to last night, when Starbucks reported again. This time, the headline numbers were a bit disappointing, with global same-store sales down 2%. Wall Street was looking for a 1.3% decline. Even though their revenue came in higher than expected, their earnings seemed to come in soft, with Starbucks earning 50 cents per share. Wall Street was looking for 65 cents. However, much of that miss was actually from one-off items like a tax charge and an expensive leadership meeting. Well, expensive, but I think it paid off. Without those, the company would have earned 61 cents per share. Still a miss, but a much smaller one. When those numbers first crossed the wire right after the close, the stock plunged as people figured, oh, here we go, another weak quarter. But then it quickly bounced back as investors spent more time looking at the quarter. First off, people saw through the confusing earnings numbers, realizing that the miss wasn't as bad as they thought. Second, while Starbucks had weak global same-store sales, there were also some very encouraging signs in certain regions. North America, which had been a real problem area, came in better than expected, with the U.S. specifically in line with expectations, not missing the estimates as it did the previous quarter. China, previously the worst region for Starbucks, was also a relative bright spot, with same-store sales up 2%, driven by a 6% increase in transactions. The disappointment here came from the rest of the international business, which had flat comps. Geez, Wall Street was looking for 2.2% uptick. It had been a really good area. Again, not great, but management's been focused on turning around the domestic business first, and they seem to be making progress on that front. Even better, when the conference call got going last night, Niccol and his team gave us many more reasons to feel optimistic. Hey, he devoted a significant portion of his prepared remarks to the company's Green Apron service operating model, which is basically their plan to improve the in-store experience here in America. Starbucks began testing this model in 1,500 stores 8 weeks ago. That's all, 8 weeks. But Niccol said that the partner feedback has been tremendous, with these 1,500 stores seeing improvements in transactions, sales, and customer service times. Given the success they've had so far, Niccol said that Starbucks plans to begin scaling up the Green Apron service across all of U.S. stores starting in mid-August. That is well ahead of their original schedule and very bullish, and why I think at the very beginning of the call he said they're ahead of schedule. Now, this morning when I spoke to Brian on Squawk on the Street, he gave us a more complete rundown on Green Apron. Listen to this.
We wanted to get back to winning the morning day part, and then we wanted to make sure we were staffed correctly throughout the balance of the day. So what you'll see with the Green Apron service model is we're reducing the number of hours where we have minimum staffing, and then we're making sure that we have the right number of partners in the right position at the right times. I think what you'll see is nice improvements in the morning day part, and then the balance of the day, what we've seen is we've also seen transaction gains there.
And that's what I found most encouraging about the Starbucks quarter. Management's plan for improving the core business here at home, they're already showing some really promising results, so much so that the company's accelerating that rollout of their new model. At the end of the day, nothing else matters for Starbucks if it can't turn the U.S. business around. Now they've gotten a proven way to make that happen. There was plenty of other positive news, too, like the solid performance in China, where Niccol said customers were responding to beverage innovation and new customization options, while Starbucks has been really ruthless about keeping prices low for non-coffee items. incentives. He also gave a strategic update on whether they might sell that Chinese business, saying that Starbucks has, quote, received significant interest from more than 20 interested parties and we're evaluating options, end quote. Though he stressed that the company remains committed to keeping some of the China business, he wants to retain a meaningful stake in it. They do want to go down to the third and fourth tier cities. That's very important. Nickel also offered a walk around the globe, touching on some other key international markets, and the commentary was much more promising than the disappointing overall international same-store sales number. Again, I felt better. Putting it all together, I think it was a very positive quarter. Even if the stock was all over the map today, I didn't want to take my cue from the stock and see more. It seemed to have more to do with the Federal Reserve. Well, that's a little ridiculous. But don't worry about these short-term swings, which were kind of a microcosm of the stock's whole first year under Nickel's leadership. Focus on what matters, the long-term turnaround plan, which is going well ahead of schedule. The bottom line, if Brian Nickel keeps delivering on the turnaround front, I bet Starbucks and its shareholders will be huge winners. That's still my expectation here, and I feel even better about it tonight than I did last night before the company reported. Let's take some calls. Let's go to Andre in Louisiana. Andre.
Hey, Jim, how are you?
I am very good, Andre. How about you?
I'm a big fan of Costco, and so I am befuddled just as you are about the price action.
Well, you know what? I am glad you called me on Costco. I was actually kind of mulling over this one with Jeff Marks, my colleague on the club, and I have to tell you, I am sick and tired of the stock going down. People feel 51 times earnings is too expensive. I think that's wrong. I think they're doing everything right. Every check indicates to me that it's time to start buying some if you don't have any. And if you have some, perhaps you should buy some more. Brandon in Texas. Brandon.
Howdy, Coach Cramer.
Hey, man. How you been?
Been all right.
Good. And what's happening?
Hey, has your stance shifted at all on GIS, General Mills?
Yeah, I've gone from here to here, meaning no, not much stance changed at all. Here's the problem. This is one of those companies that, frankly, is part of what I talk about as being in the heart of the inflation complex. They've got food that costs too much. They have input costs that cost too much. And they're going to have to sacrifice their profit margin and bring their food price down, or else they're not going to do the business that they used to do. And no one wants to cut their margins. They're afraid about what will happen in the stock market, but all that's going to happen is the stock's going to go down anyway. All right, if Starbucks keeps delivering on the turnaround Nickel promised today, I think this stock could get a double shot of a boost. Now, there's much more mad money ahead, including my exclusive with data center player Vertiv. Could Wall Street be underestimating the power of the AI build-out, especially after the earnings we saw tonight? I'm getting the latest from the CEO. Then the consumer's still feeling this pinch from high prices. So what is it really going to take for companies to ease up at the register, like I just mentioned with General Mills? I'm going to give you my take. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. This morning, we got some excellent results from Vertiv Holdings. That's the maker of specialized power and cooling equipment for the data center, which has been a phenomenal winner over the past few years. The company reported numbers that came in well ahead of expectations in nearly every line. Sales up 35% year over year. 12-cent earnings beat off an 83-cent base. Even better, Vertiv issued a strong outlook for the current quarter and raised its full-year forecast. It's very strong backlog, too. However, after being up nearly $11 at one point today, that's like 8% in early trading, the stock gave back essentially all those gains throughout the course of today's trading session. But like I said at the top of the day, what mattered is the Fed, and that somehow interfered even with this great company. I'm not too worried because this feels like a normal profit-taking day in a stock that at its highs was up 186% from its post-Liberation Day lows. But still, let's take a closer look with Gio Albertazzi. Gio is the CEO of Vertiv Holdings, and it's great to have you back, Gio. Welcome to Mad Money.
Well, thank you for having me, Jim. It's great being with you again.
All right, so Gio, some of these just jump out. Net sales up 35%. Organic orders up 15% year over year and up 11% sequentially. Robust backlog, $8.5 billion. Tell us about some of the factors powering what I regard as incredible sales momentum.
Yeah, it is certainly a very strong quarter and a very strong trajectory. And there are two factors. we're serving an industry that is very strong, and you've been vocal about the industry, the data center AI as a very strong long-term trend, secular trend, and it is really happening. And we have a great portfolio. We continue to expand our portfolio, and in this market, we're taking also market share. We're growing more than the market, as we promised to our investors already when we had our investor day in 23 and in 24. So it's happening.
Well, I thought it was very interesting. I know Dave Cote starts your call. Dave, we know from previously from Honeywell. In the digital revolution, he says, that's got a long way to go, and data centers remain fundamental to all of it. So you guys fit right smack in the middle, and yet at the same time, I was trying to understand something you were talking about, and I don't mean to say that I'm ignorant, but you're talking about where you sit exactly in between a lot of different situations, and I need you to describe it, because I know you think it's incredibly important to say where you are in the food chain, strength in data center, gray space, and white space?
Yeah, absolutely. So you opened up the conversation talking about our power and thermal portfolio offering strength. That's what we do, and that's what we've done historically. So think about the data center. There is a big power infrastructure. There is a big cooling infrastructure, and it all to power the IT stack. Think about a big facility that supports the IT stack. But the interesting thing is that as the power density increases, and we know that power density from a rack is going from a traditional 10 kilowatt per rack all the way to north of half a megawatt per rack, well then that IT part that we call in the industry the white space, it's becoming so dense that the power, liquid cooling, the power and the liquid cooling and the cooling become one thing almost with the IT. So there is that sharing the same space. And that makes the white space that for us was a little bit remote in the past, an area where we play, and not only where we play with our cooling and power technology, but where we make the difference in terms of enabling our customers to really utilize the new and future technology that is increasingly high density. Thinking about the future and the new the GPU technology, the GB300s, and then the future, even more powerful GPU technology. Well, that is happening. White space is becoming more important for us, and we play a bigger role.
No,
there.
this is important because your partners, we happened to have the pleasure of going to a CoreWeave center where all we saw was Vertiv everywhere, of course, some NVIDIA GPUs. I've not been to a nuclear technology site where I know you're working with Oklo. That's incredibly exciting. So talk to me about the CoreWeave partnership, the Dell partnership, and the Oklo partnership.
Well, certainly CoreWeave is an important partner of ours, and we're extremely proud of having been part together with Dell of enabling the first colo level GB300 deployment. And really, it's a collaboration with NVIDIA, with Dell, with CoreWeave. Our cooling technology was an important part of that stack. So clearly, working with all these enormously important players. But there is an aspect, we go to Oklo and to nuclear technology of, the data center needs power. The data center needs power, and there is more and more data center design thought process oriented towards being off-grid and having local power generation. And certainly, small nuclear reactors are certainly a credible solution, maybe a little bit out in terms of time, but it's going to happen.
All right.
So that comes, of course, with the need to power and cool that part together in an integrated manner with the rest of the data center. That's what we do.
I think you're going to be around a long time, so that is absolutely right to be focused on. One last thing I do want to be concerned with, margin pressure, particularly from operational inefficiencies, but also from tariffs. You mentioned that tariffs were higher than anticipated. It hurt the supply chain and manufacturing transition. Is this something we need to worry about, or something that is just going to be what the Fed chairman calls transitory?
It is transitory for us. in the sense that we believe that end of 2025 we will have tariff offsetting actions that really offset the impact of tariffs for us. But there is a transitional element in which you move supply chains, you redeploy backlog from one place to another. You have, accelerated shipments. There is a lot of work in terms of bringing up the supply chain and manufacturing footprint from one place to the new place that really offsets the tariffs. But there is also an element of pricing in the tariffs that, of course, is kicking in. So there are a lot of things at play, and we call this really the transitory cost of tariffs. But also, one thing that I like to say is we've been growing in Q2 at 35%, and put tariffs and tariff supply chain reconfiguration with that. That's a lot of stuff going on. And for an industrial company having to handle all that, there is a lot of work. So hence the inefficiency. We have a very, very sharp and focused operational programs to tackle those, and we feel good about how we're gonna end the year and the trajectory.
All right,
going
then
out
I'm not going to be as concerned about that. I thank you for explaining that to us. Obviously, the core business is on fire, and we know that from some of the things you guys do with the big hyperscalers too. So I want to thank Gio Albertazzi, the CEO of Vertiv. Gio, it's great to see you. Thank you.
Likewise. Thanks.
Absolutely. Net Money's back to you.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the light round. Chris Betts, round for gold, Sarge, Sam, the stock total buy, sell, silver, the core stock, my staff, person, plan to sell. And then the lightning round is over. Are you ready, Ski Derek? Come to the lightning round. Kramer's Mug. Let's go to Frank in New York. Frank.
Dr. Cramer, I'm hurting. I own Uber. I own Uber. They're fantastic. They're a cash flow juggernaut. You need to wake up the people. You got to give one of your they know nothing speeches and wake these people up. This company should be $120. Okay.
Look, it's stocks up 45%. I got a lot of stocks that are down. Those are the ones I got to wake up. I think Uber's going to 200. I just say you go buy more here. That's the only solution that I see. Let's go to Ian in Florida, please. Ian.
Hey, booyah, Jim. How you doing?
Booyah, right back at you. Doing well. How about you?
Doing excellent, Jim. Thanks. Third-time caller, Investing Club member.
All right.
Jim, I wanted to get your feedback. What do you think about this chip stock? Been performing okay lately. We've had a bit of a pullback. Is it a good time to get into Micron?
Okay, the problem with Micron is it's got two businesses. It's got high bandwidth memory, which goes into, yes, the data center, NVIDIA, and then it's got DRAM, plain old DRAM. DRAM pricing has not been good, which is why the stock dropped from the 130s all the way back to where it is. I would say this. I think you can buy a little bit here, but we do need to see DRAM pricing go back up before you get a lot of good pin action in that stock. Let's go to Gary in New Jersey. Gary.
Greetings from Cherry Hill, New Jersey, Jim.
Love it. I used to go to the Latin. What's happening?
I love it. My stock is key. Do you think they'll bought out soon? It looks like we have good fun.
You know what? That's an interesting question. But we had Chris Gorman on, and Chris was also on another show recently. I don't think they're in any. I think they're in expansion mode. I don't think they're in sell mode. But I don't mind owning the stock at all, especially with that 4.5% yield. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, rates, tariffs, and supply chain. Cramer's breaking down all that's driven prices higher and what it'll take for rising costs to finally break. Next.
Everything's changed since COVID, but we just keep acting like it hasn't. We are always surprised when we hear that higher prices are hurting demand and a company isn't doing that well. That's how I felt about the plummeting price of Chipotle stock. I was checking it out after talking with Brian Niccol, the current CEO of Starbucks, who came over from Chipotle about a year ago. When Brian left, the stock was at 56. The S&P 500 was at 5648. Now the stock's at 43 and change, while the S&P's at 6362. Well, what's happened here? It's not the in-store experience. Chipotle's the same place it was always. It's just gotten a lot more expensive. With the aid of one of the generative AI platforms, which source from social media posts and various media reports, we can see that from 2019 until now, the price of a chicken burrito at Chipotle has gone from around $7 to the low double digits. A steak burrito has nearly doubled in that time frame. It's in the low to mid-teens. Carnitas is up 25 to 50%. You get a bowl with guac and soda, it's gone from the low double digits to the low 20s. And look, I'm not trying to pick on Chipotle, and I recognize those prices are all over the map, given their crowdsourced nature. So many restaurants, so many kinds of stores, so many homes, so much entertainment, all is the same problem. But to not relate Chipotle's stock price to these to what's happening with the prices, well, that's just fanciful. The consumer's just paying a lot more, and nobody likes that. Which brings me to the Federal Reserve and its decision to hold off on cutting rates. I think they're worried about another round of price increases, this time from the tariffs, not from COVID. Normally, at this point in the business cycle, we'd expect a wholesale lowering in prices as companies try to get their sales to reignite, even at the cost of profits. Much harder for that to happen if all our imports are about to be roughly 15% more expensive. Doesn't help that we have a 3% GDP growth and a very low unemployment rate. There's no way prices are coming down with that backdrop. Now, I know there's a tendency to blame all this on politics, and I don't want that here. You can point to Biden's deficit spending or Trump's tariffs and unfunded tax cuts. I don't care. I think it misses the real issue because the whole world had elevated inflation since the pandemic. In reality, COVID led to a lot of scarcity, a lot of supply chain problems that caused prices to rise. And once we got over the pandemic, well, guess what? Businesses kept their prices up. They should have lowered them. Why didn't they? Other than televisions, I can't find anything that's retreated in price, just some things that didn't go up as much as others. All that said, relatively high interest rates haven't done much to push prices back down. I can see why President Trump wants rate cuts. All presidents want lower rates. They're usually just more subtle about it. Lower rates could theoretically lower the price of housing, which is a huge portion of a family's budget, and lower rates will save money. However, homes might go higher in price because of more robust demand from lower rates. And it's hard to see how lowering the cost of borrowing will lower the price of goods that have just been marked up by tariffs. No, the only thing that will get prices down is a strike by you, the consumer, a strike that simply hasn't happened. You need people to stop going to expensive entertainment events. You need them to stop shopping anywhere besides Walmart and Costco. When there have been buyer strikes like you've seen at Lulu or perhaps Chipotle, there is pressure to cut price. But Wall Street doesn't want companies that do that. Wall Street wants higher prices and better sales, even as we keep realizing how impossible that combination has become in this new environment. I think it's why we tend to look at other sectors, especially tech, where pricing isn't a factor, as witnessed by the blowout numbers this very evening from Microsoft and Meta. Right now, though, as long as people keep buying from these companies, they'll keep raising prices no matter what the Fed does. I'm not saying that everyone's price gouging. No, I'm just saying that businesses exist to make money for their shareholders, so they won't cut price unless their customers finally force them to. Luckily, in some cases, that's already happening, but it's just not happening fast enough to allow the Fed to restart the rate cut engine. I'd like to say there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.